Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Dennis Dick, and we have Kevin McPartland on the line. He's a frequent guest on our show. He is the let me find my sheet here at Greenwich Associates. He's a market structure specialist. How you doing this morning, Kevin?
Fantastic. How are you guys?
We're doing well here, Kevin. So I want to talk to you about what happened last Monday there. Obviously not this Monday, but the previous Monday when we had what some people are calling the flash crash Monday there. I was kind of analyzing the tapes there a little bit, and it looked like a liquidity event to me. It didn't look like this rash of sellers. It looked like there simply wasn't a lot of buyers in a lot of stocks. When I looked at the tape of General Electric and Costco, which was a stock that fell 25% that day, a couple other ones like Pepsi fell over 25%. I just wasn't seeing any bids out there. And I'm concerned that, obviously this, liquidity, this is kind of similar to what happened back on May 6, 2010 when we didn't have any bids. Now, there wasn't no bids at all, but there was a lack of participation. Are you concerned about something that I've been calling homogeneous liquidity, where most of our liquidity providers are now maybe short-term, high-frequency traders, electronic market makers, and that they obviously are trading similar strategies and are quick to cancel when the going gets tough?
Yeah, possibly, right? But I mean, I don't know. I tend to look at the last couple of weeks as much more of a sort of macroeconomic event than I do as sort of a market microstructure event or something to be sort of blamed on blaming high frequency traders for.
Well, I'm not blaming, just to interrupt you there, Kevin. I'm not blaming high frequency traders. I'm blaming the fact that we don't have any other market makers, it seems like, out there. Like, I know and me and Joel were talking about the Volcker rule. Is this an issue where big banks aren't participating anymore in providing liquidity? And maybe that's why we can have these liquidity type of events where maybe, we should have reconsider, and maybe we should be allowing maybe some of the banks to make markets and securities. Because let's look at the NYSE floor. I mean, there's 6 market makers down there now. They're all electronic market makers. I'm just concerned that we don't have diversity in our market making pool anymore.
No, no. So, and that's great. You raise a really great point, right? And this goes on across all asset classes. And we've been doing research in some of the bond markets and in the equity markets as well, talking to major banks about sort of what their activities for. And most of the trading they do today is essentially directly for clients or to hedge client risk, and there isn't any of sort of traditional market making going on anymore. Meaning that they're not just sort of sitting out there on the bid and the offer all day and as a strategy, right? So I think you're right. I mean, it's certainly changing the dynamics of the market quite a bit. As much as some people think prop trading by the banks just sounds wrong. They've got tremendous balance sheets. The markets really need those balance sheets to sort of remain fluid, right? So, yeah. I guess if we go back to the specific cases of the last couple of weeks, I think everybody's just a little bit on edge, right? The stock market seems like it's getting too high. The interest rates are too low for too long, and the bond market seems like it's a bit too high. So how is this all going to end? It's hard to gauge. I don't think we've ever seen a period like this in history before, and what's going to happen next? It's actually surprising that it took so long for volatility to return to the market. I frequently look at the chart that'll show me rate, currency, and equity volatility across the world, and it's FX volatility has spiked a bit over the past, say, 12 months, but it had been surprising how rates and equity volatility hadn't, of course, until the last couple of weeks.
Kevin, another issue with that Monday, and obviously I wasn't blaming high frequency traders, just to clarify, but I was just talking, with somebody else about the circuit breakers there as well, and the individual stock circuit breakers, and on the individual ones on the limit up, limit down. A lot of people don't realize this, but for the majority of the stocks, they don't kick in until 15 minutes after the open at 9:45. So if you would have had the limit up, limit down circuit breakers on a stock like General Electric, it would have paused for 5 minutes of trading when the stock fell to that lower band, which I think on GE is like 3% or 5%. I'd have to look it up to see if that's what that level is, but it wouldn't have fallen 20% in that first couple of minutes. Do you think those circuit breakers maybe need some tweaking, and maybe why not have them running in the first 15 minutes?
Yeah, I mean, it comes right. I mean, there was a lot of debate about Rule 48 right over the last couple of days as well. Some of my colleagues sort of dug into that, And I think one of the issues this brings up is, where in these markets that are so fast and so automated, where does manual intervention make sense, right? Where is it helpful to have, humans step in and say, okay, what's going on? Does this seem reasonable? Should we slow things down a little bit until we can get our act back together? And I think that's why the floor of the exchange still has a place, right? Whereas maybe on the surface, if we were to start from scratch, that floor maybe never would be created. I think that sort of manual step of human eyes saying, wait a second, does this look right? Maybe we should stop for a second. It has its place. Although I think to your point, these rules do need a continuous tweaking. These markets are evolving so quickly, and a lot of the sort of new circuit breaker rules have come in a period of pretty low volatility. If they start kicking in more, we're going to have more situations like this that we can use as a test case that does this work, and how should we make it work a little bit different.
There's going to be a lot of data to analyze from this event. Obviously, when you look down, and I just took about 25 minutes. I was just looking at the tape, and that's where, I was coming to the conclusion that this was more of a liquidity event, because when I looked at Costco and I was looking at the bid-ask spread just at the time when the stock traded from 137 all the way down to 117, this was the bid. The bid was $117 for 200 shares, and the best offer was $125 for 500 shares. It had a 7-point spread with 200 shares on the bid and 500 shares on the offer. And I watched it trade back and forth between 125 and 117. And actually, it wasn't even trading at the bid and the offer. It was trading in front of it. And that's another issue I have as well. So the one person that was willing to bid the stock out there wasn't even getting filled, because you have off-exchange market makers that can match the quote. Is it an issue that maybe too much of our volume's going off-exchange and it could be discouraging lit liquidity as well?
I don't think so, right? I mean, if you look at the percentages, it's not enough that it should make such an extreme difference, right? I mean, you're right. That spread is crazy. That should never happen.
Never.
There's enough access to the market. There's enough market participants. Even if we talk about the banks sort of backing away from their market making duties, that should never happen. I agree with you, but I don't think it's an off exchange liquidity issue, right? Especially when you're talking about 200 share orders. That's not what's going off exchange, right?
Well, I'm just saying, if I was bidding out there at 117 and I was the one person in the whole world that was willing to bid 117 and I didn't get filled on that order, how much does that discourage me from posting a bid in the market? And it's not only that, it's just hidden liquidity as well, because a lot of your exchange liquidity is becoming hidden as well too. I know I use hidden orders in my trading, because if I throw a limit order out there, I get stepped in front of either by an automated trading system or off exchange. There's always a way. It seems like my limit order is just not getting filled when I feel like it should be. So it's it's just the dark trading maybe overall, that includes off exchange trading, but also the dark trading that's happening on the exchange. I just don't know how we can encourage more liquidity providers to come into the market when stuff like this happens, if we're not giving them fills even when they do come into the market.
Yeah, right. Because it seems counterintuitive. With spreads that wide, that should look like a huge opportunity to get into the market, right? As soon as spreads widen out, then everybody should jump on it and pull it back to earth.
Yeah. But if I went 118 for that bid, I probably wouldn't get filled, because this thing would be trading in front of my quote at 118, or you'd have an algorithmic penny jumper that jumps at me at 118.01, 118.02. So really, what is the point for me coming in to buy? Not saying, that my bid's going to make that big of a difference, but when there's no liquidity out there, like in that case, it can make a big difference, and a few buyers or a few other players out there might help.
Yeah, no question. And we've thought a lot about the implications of Volcker across the board, and we do a lot of as we've talked about in the past, right? If you look at the bond market as well, it's considerably worse in places like corporate bonds and U.S. Treasuries, right, where the dealers were the liquidity source and have been less willing to put their balance sheet forward. The same thing is true here in equity. So, I think talking about sort of Volcker as a yes or no equation is it's a little too, that oversimplifies things too much, right? It's hundreds and hundreds of words of regulatory text, but in bits and pieces where there's concern, regulators are expressing concern about market liquidity. That's it. I mean, we need to incentivize folks to be there, and a lot of the new regulations have done exactly the opposite.
We're on the line with Kevin McPartland. He's a principal of market structure and technology at Greenwich Associates, joining us here on Benzinga's pre-market prep. S&P's just made a new low, 21 even, 22 even was the old low, so finding support in the lower 1920 handle. Kevin, Rule 48A, indiscriminately, I guess, can be enacted by the exchange. And man, oh man, I mean, and we had Tim Anderson on from the floor, and that's sending liquidity elsewhere. And it really wasn't Monday or a week ago Monday. Wasn't that like the perfect storm? That you had the big open, you had the futures hitting limits. Kind of everyone was in the dark here, and then they invoked that rule, and then that even makes it the illiquidity worse.
Yeah, yeah. No, so, I mean, it's certainly something that should be sort of re-examined. I think that was a perfect example for it, and most market participants and observers, agree. Right there, like we said before, there's some place for manual intervention, but if it slows down the market to the point that we start losing liquidity at a point where we really need it, yeah, I mean that's certainly something that I think the exchange is going to have to re-examine a bit more closely, and it's maybe again not about pulling rules like that completely away, but thinking about them in the context of today's market to figure out what really is the best path forward.
Kevin, let's move away from the market structure talk just for a bit. What are your institutional clients saying? Obviously, we've had some massive volatility here the last couple of weeks. And, some people are really, it feels like it's almost like a big battle between the bulls and the bears here. You had the big washout low there, a week and a half ago on that Monday. Now we've bounced back significantly. Some technical traders are saying we got to go down and retest those lows. Others are saying, well, that was the big correction and we're moving higher here. Do you have any feel for what, the institutional clients saying about this?
Yeah, I mean, again, everybody's still on edge, right? I don't think anybody knows exactly what to do with their money at this point. It's funny in my head when these days happen, and everybody's talking about where's the S&P and what's the market doing. My eyes immediately go to volatility, and when I see a jump in volatility, my head just thinks, okay, well, so now the big banks maybe they can make some money again, right? And by the banks making money, it sort of gets the whole system up and moving a little bit more, right? Volume is generally a good thing. But yeah, I mean, from the investor side, of course, it's a whole different story. Volatility sort of makes everybody scared. The last thing we want is, retail investors freaking out and, deciding it's time to go away, right? My father, a few years away from retirement, isn't too happy when he sees, the market take 10% dips. With still a good portion of his retirement in equities. So, yeah, I mean, I think there's just a tremendous amount of uncertainty out there. Regardless of the asset class, everybody still seems to look back to, what the Fed is going to do with interest rates. And what's ironic about that is, even if the Fed was to move, it's only 25 basis points in all likelihood, and which still leaves interest rates at ridiculously low levels, right? So that shouldn't really have that big of an impact on the economy. I think we're at a point where we just need to pull the Band-Aid off and get it over with. So maybe we can focus more on fundamentals again, and rather than just being sort of over obsessed with monetary policy.
Kevin, you brought up a good point there. You mentioned your father. I think when a lot of times when evaluating these markets, you have to do it or where you at in the investment cycle and what your expectations are. And, if you're elderly, you're looking to retire, I mean, you have a lot of funds in there, maybe taking some chips off the table or perhaps getting, some kind of protection. I mean, the market gave you a lot of time up there. I mean, it's not exactly like it. I mean, we did had the vacuum, but if you look at the better part of April, May, June, and July, market gave you plenty of opportunity here to, at least put some hedges on or lighten up a little bit. We've been on the line with Kevin McPartland. He is the principal of market structure and technology at Greenwich Associates. He's given us a little bit of perspective on the manic Monday. So thanks a lot, Kevin. We'll talk to you again soon.